In the high-stakes arena of the markets, where fortunes are won and instantly vaporized, there is only one true measure of a trader: survival. Not brilliance, not luck, survival. I want you to look back at your trading journey, at the countless hours spent staring at glowing screens, at the dizzying highs of a winning trade, and the gut-wrenching lows of a loss that felt like a personal betrayal. Most educational content focuses on finding the perfect entry, the elusive setup that promises a massive, immediate payout. We are taught to chase the green, to maximize our gains, and to dream of that one trade that will change everything. But here's the brutal truth that separates the perennial players, the legends like Jesse Livermore, from the flash-in-the-pan speculators who vanish after a single bad cycle. The entry is secondary to the exit. Think about that for a moment. You can have the best trade idea in the world, the most perfectly charted trend, the most compelling fundamental story. But if you do not master the exit, particularly the panic exit, the one where you are forced to admit you were wrong, you are simply renting time in the market until it repossesses your capital. The market is an unforgiving landlord. Jesse Livermore, the legendary speculator, knew this intimately. He lived through the greatest financial panics of his time, from the early 1900s to the devastating crash of 1929. He made fortunes, and he lost them, sometimes completely, only to claw his way back to unimaginable wealth. His legacy isn't built on his biggest win. It's built on his resilience, his ability to return. And his ability to return was anchored to a single, stark, unromantic rule that he considered his life insurance policy in the financial world. This rule is not complex. It doesn't require a master's degree in finance or access to proprietary algorithms. It is a psychological decision that must be made before you ever place a trade. And it is the absolute secret to longevity. Most traders, especially in the modern, fast-paced digital environment, approach the market with a mentality of hope. They hope the trade turns around. They hope the news release will save them. They hope the loss won't get any bigger. But hope in the market is an expense, not a strategy. It costs you money, opportunity, and, eventually, your career. We are not here to talk about how to win. We are here to talk about how to not lose badly. Because the greatest edge you can possess is the guarantee that you will be around to place the next bet. Livermore understood that his capital wasn't just a number. It was his army, his ammunition, and his opportunity ticket. To allow a loss to run unchecked was to commit strategic suicide. This first rule is a covenant with yourself, a promise of discipline that transcends every other technical or fundamental analysis. When a trade goes wrong, and they will go wrong, the greatest pressure is the internal one, the ego screaming, "I cannot be wrong." This pressure, this denial, this paralysis in the face of mounting losses, is where careers truly die. Livermore's number one rule is the fire break against this psychological inferno. It is the simple, yet brutal, definition of when enough is enough. If you master this rule, you move from being a hopeful gambler to a disciplined speculator. And that, my friends, is the most crucial transition you will ever make. The market rewards discipline and punishes emotion. And this rule is discipline distilled to its purest, most essential form. It is the foundation upon which multi-million-dollar campaigns are built. We are about to strip away the complex layers of trading and get to the core of what truly matters for survival. The central paradox of trading, the one that trips up even the most intelligent individuals, is this: we instinctively hold on to losers and quickly sell our winners. Think about it in the context of any other investment or business decision. If you bought a restaurant that was consistently losing money, month after month, would you keep pouring your savings into it, saying, "Just a little more capital, it has to turn around"? Of course not. You'd initiate a damage assessment and strategic retreat. Yet, in the stock market, when that red number flashes on your screen, a switch flips in the human brain. It is the switch of denial. That losing trade ceases to be a position. It becomes a personal challenge. Your mind starts playing tricks on you, whispering that if you sell now, the loss is realized, it's permanent. And, more painfully, it's an admission of error. As long as you hold it, it's merely a paper loss, a temporary inconvenience. This psychological defense mechanism is the silent killer of trading accounts. We are programmed to avoid pain, and admitting we were wrong is a form of emotional pain. Jesse Livermore recognized this inherent human flaw and built his entire methodology around counteracting it. He observed, famously, that a speculator is doomed when he allows his personal opinion to interfere with his judgment. This personal opinion is the inner conflict itself, the war between the logical speculator who knows the market is signaling danger, and the emotional human who wants to avoid the sting of being proven wrong. When you allow a loss to run, you aren't waiting for the market to validate your initial idea. You are waiting for the market to forgive you for your mistake. You enter the deadly realm of getting even. This mindset shifts your focus from the opportunity in the future to the mistake in the past. Every point the stock drops, your internal monologue gets louder, fueled by a dangerous mix of anger and hope. The anger is directed at the market for not cooperating. The hope is that it will rally back just far enough so you can exit at your cost price, breaking even, thus saving your ego. But what happens to your winning trades during this time? The moment they show a modest profit, say 5 or 10%, we feel an immediate, urgent desire to capture that gain. That profit feels fragile, like a small bird we must catch before it flies away. So we close the winner, take the small, quick win, and feel good about ourselves. Meanwhile, the loser sits there, growing larger, consuming more of our capital and our mental bandwidth. The result is a portfolio of big losers and small winners. A recipe guaranteed to drain an account over time. Livermore's #1 rule is a direct assault on this deeply rooted human paradox. It's the mechanical, cold-blooded tool designed to eliminate the internal debate. It removes the human element of hope and denial from the loss-cutting decision. He knew the market's job is to take money from the impatient and the emotional, and to give it to the disciplined and the patient. And the discipline begins not with patience for a winner, but with zero tolerance for a loser. The inner conflict will always be there, but Livermore provided the script for the logical voice to win the argument every single time. Our next step is to examine the specific psychological trap that paralyzes us, turning a small, manageable error into a catastrophic account destroyer. It's the ego that costs you money. We talked about the inner conflict, the war between the logical speculator and the emotional human. But what is the weapon the emotional human uses to win that war? It is the ego's refusal to be wrong. This is the core problem, the central psychological trap that turns a $100 loss into a 5-figure catastrophe. When you place a trade, you are making a public declaration, at least to yourself, that you have figured out the next move of a $1 trillion global machine. And when the market immediately or slowly begins to move against you, that declaration comes under attack. The immediate reaction is not fear, it is defense. You start looking for reasons why the market is wrong, not why your analysis was flawed. It's just the news cycle. It's a temporary pullback. The fundamentals haven't changed. This is your ego building a fortress of excuses to protect its central claim. I am right. This defensive mechanism is so powerful because, in every other aspect of life, business, career, relationships, we are often rewarded for perseverance and sticking to our guns. We are told to never give up, but the market is the one domain where never give up is the most expensive advice you can follow. Jesse Livermore understood this perfectly. He recognized that the market is inherently impersonal and does not operate on a moral code of fairness or loyalty. Your loyalty to a stock or an initial idea is simply an opportunity for the market to take advantage of your emotional bias. The trap deepens with the concept of anchoring. You are anchored to the price where you bought the stock. Every time you check the position, your mind compares the current, lower price to your entry price. The difference is registered as pain. The only way to stop that pain, your brain tells you, is to see the price return to your entry point. This becomes a psychological obsession, the desire for a clean slate, for a trade that simply didn't happen. This obsession paralyzes the decision-making process. This is where Livermore's #1 rule performs its most vital function. It is the predetermined breaking point that removes the decision from the ego's control. It is a hard line in the sand. Livermore learned this through several bankruptcies. He lost his fortunes not because he didn't know how to make money, but because he didn't know how to stop losing when he was wrong. He famously said, "The loss should never worry you, but what causes you to lose should." What causes you to lose is the violation of this rule, the decision to hope instead of to act. The psychological trap is waiting for you in every volatile session. It is the insidious feeling that if you just wait 10 more minutes, the trade will turn. But those 10 minutes turn into an hour, and an hour turns into a day, and suddenly the small loss that was manageable and could have been easily recouped with the next trade has grown into a hole so deep it takes weeks of perfect trading just to climb back to flat. This trap is not about market movement. It is about self-deception. The minute you find yourself justifying the loss, arguing with the price, or avoiding looking at your account statement, you are already caught. The only way out is a pre-commitment to a mechanical, non-emotional exit. This is the ultimate lesson in financial humility. I want you to understand the mindset of a man who repeatedly went from riches to ruin and back again. When Livermore was losing, he wasn't lacking intelligence or market knowledge. He was lacking systemic discipline. He realized that the human element, the ego, the hope, the desire to be made whole, was the constant variable that derailed his best laid plans. His perspective was ruthlessly simple, almost brutal in its logic, but it was the logic of a survivor. Livermore's number one rule for cutting losses wasn't about avoiding a bad trade. It was about avoiding a bad habit. He defined the exact percentage loss he was willing to accept, asterisk before asterisk he ever committed $1. And that percentage was small. For him, a loss was not a moral judgment on his abilities. It was simply tuition paid to the market. This phrase, tuition paid, is central to his philosophy. It means two things. 1. A loss is an expense of doing business. Every business has overhead, and in the market, your overhead is the inevitable run of trades that go against you. You budget for it. You accept it. 2. A loss teaches you something valuable. You paid to learn that your initial read on the market was incorrect, or that your timing was off. The goal is to pay the minimum tuition fee possible for that lesson. The problem, as Livermore saw it, was that most traders allowed the small tuition fee to balloon into a devastating tuition bill. They would tell themselves, I'll wait until it comes back to break even, which is essentially telling the market, I'm going to hold this position until you validate my ego. Livermore recognized this was a fatal error. He famously said, it is foolhardy to make a second trade if your first trade shows you a loss. Never average losses. Let a small loss clear your head and give you the opportunity to re-examine your entire position. This is the core of his perspective. His rule was not just a stop-loss measure. It was a psychological circuit breaker. By mechanically cutting the loss at a predetermined small point historically, he often spoke of a 10% tolerance in his time. But the principle is the same. He achieved three crucial things. Preservation of capital. He kept the majority of his ammunition ready for the next, better opportunity. Preservation of sanity. He avoided the agonizing stress and mental energy drain of watching a loss spiral out of control. A trader consumed by a losing position cannot see new, winning opportunities clearly. Preservation of objective judgment. By closing the trade, he instantly removed the emotional attachment and could look at the market impartially again. He could ask, what is the asterisk market asterisk doing now? Instead of what does the market need to do to save me? Livermore understood that the greatest fortunes are made by having sufficient capital available when the truly big moves finally happen. If your capital is tied up in a dozen mediocre, losing, or stagnant positions, you are sidelined during the life-changing moves. His number one rule wasn't just about minimizing damage. It was about maximizing future opportunity. He paid his small fee, got out, and waited for the perfect moment, the pivotal point to re-enter with full strength. That, my friends, is the perspective of a true market master. In the market, the difference between a minor flesh wound and a fatal hemorrhage is the speed at which you admit, I was wrong. To understand the brutal necessity of Livermore's number one rule, we must look at a moment in his life that defined his return to grace. Imagine the year is 1915. Livermore, already a figure of legend and controversy, had just gone through his second and most devastating bankruptcy. The market had, quite literally, stripped him bare. He wasn't trading on massive capital. He was trading on a shoestring, a small account provided by friends, and crucially, on the hard-won psychological lesson of his past failures. The mistake he had made in the preceding years was a classic violation of his own later rule, averaging down. When he would get into a large position, and the market would move against him, the ego would whisper, this is a temporary discount. Buy more, Lower your average cost. You'll make back the loss faster when it turns, but by averaging down. He was not lowering his risk. He was dramatically increasing his exposure to a fundamentally flawed position. He was throwing good money after bad, turning a small mistake into a catastrophic commitment. Now, picture him in 1915, humbled and rebuilding. He takes a small, cautious position in a stock. Almost immediately, the stock moves contrary to his analysis. It doesn't plunge, but it drifts lower, testing his predetermined stop-loss point. This is the moment of truth. The small account is precious. The instinct, the memory of his past, tells him to hold, to wait, to hope it rallies just a bit. His knowledge tells him the move is minor, possibly just noise. But his new discipline, forged in the fires of financial ruin, overrules both instinct and knowledge. He had made a covenant with his capital. I will only risk a small, manageable percentage on any one trade. He executes the sell order. The loss is small, a mere fraction of his capital. It stings, but it doesn't break him. It doesn't consume his energy. He is out. He is clean. He then steps away from the ticker for a moment. He clears his head, just as his philosophy dictates. And what does he realize? His original analysis was fundamentally correct, but his timing was wrong. By cutting the loss quickly, he hadn't destroyed his capital. He had preserved his flexibility. The capital was now free, waiting. A few weeks later, the market gives him a clear second signal, a pivotal point entry that is undeniable. He re-enters the trade, not with the capital he would have lost by averaging down, but with his full, preserved capital. This time, the trade moves exactly as expected, and it becomes the foundation of his next great fortune. This story is not about the trade. It's about the two versions of Jesse Livermore. The old Livermore would have held, averaged down, stressed, and been crushed by the stock's eventual, sustained move against him. The new Livermore, the disciplined speculator, adhered to his number one rule. A small loss is cheap insurance against a total loss. He accepted the small pain, maintained his capital, and was financially and psychologically ready when the real opportunity presented itself. His quick exit was the most profitable decision he made, because it was the decision that allowed him to be available for the next massive win. This is the secret to longevity: not making one great trade, but ensuring you can be around to make the 1,000th great trade. But why is this so hard for us to replicate? We know the rule, yet we struggle to enforce it. Let's dive into the emotional low point, the point of no return, where most traders finally capitulate and destroy their accounts. Every great market disaster begins not with a stock crash, but with a trader's slow surrender to the most toxic emotion in finance, shame. We've established that the ego initiates the defense mechanism, forcing you to hold onto a losing trade. But what happens days or even weeks later, when that small, manageable loss has metastasized into something truly threatening, consuming 20%, 30%, or even half your capital? This is the emotional low point, the turning point of failure, and it is characterized by the paralyzing feeling of shame. The trader is no longer arguing with the market. They are now battling their own self-hatred. Asterisk, how could I be so stupid? Asterisk, why didn't I sell when the loss was only 5%? Asterisk, the trade has now become a secret, a number that the trader is afraid to look at, and certainly afraid to show to anyone else. This isolation fuels the worst decisions. You avoid checking the screen. You avoid the trade journal. And you start hoping for a miracle, not a rational turnaround. This is the point of paralysis. At this low point, the trader's mind performs a final, desperate calculation. They see the loss and realize that to cut it now means they have to make 2 or 3 consecutive perfect trades just to get back to zero. The path back is too steep, too arduous. The initial small loss required a small, single effort to recover. The massive, running loss demands Herculean effort. And the trader, already exhausted by weeks of psychological stress, feels defeated. This emotional exhaustion is exactly what leads to the ultimate failure point, capitulation. Capitulation rarely happens at a planned stop loss. It happens when the emotional pain of holding the loss finally outweighs the emotional pain of realizing the loss. The trader clicks sell, and the trade is gone, but the damage to their capital and, more importantly, their confidence is profound. Jesse Livermore was intimately familiar with this devastating low point. He realized that the stress and shame of watching a large loss erode Capital not only destroys the current account but also contaminates the mind for future trading. He couldn't afford to have his focus blurred by regret and denial. His famous number one rule is specifically designed to prevent the trader from ever reaching this state of emotional low point paralysis. He knew that the market is a psychological arena, and the trader who is unburdened by significant losses is the one who can see the clearest opportunities. A small loss is like a cut you immediately bandage. You can keep running. A massive loss is like a broken leg you try to ignore. You are sidelined for the rest of the race. The turning point is the moment you choose discipline over denial. Do you take the 5% cut and maintain your mental clarity? Or do you wait for the 50% hole and suffer the subsequent shame and defeat? Livermore's breakthrough was the realization that emotional pain is proportional to the size of the loss. By strictly capping the loss at a small, predetermined percentage, he kept the emotional response equally small, ensuring he never reached the point of emotional exhaustion that leads to financial ruin. He turned a potential emotional crisis into a simple, mechanical transaction. So, having seen the destructive power of shame and capitulation, what is the precise, clear, and unambiguous rule that Jesse Livermore codified? It's a lesson in simplicity, a surgical tool against the complexities of human emotion. Let's uncover the breakthrough rule itself. This is not advice. This is an order. It is the single, non-negotiable principle that separates the professional speculator from the reckless gambler. After years of agonizing experience of making and losing millions, Jesse Livermore distilled his survival strategy into a rule of almost brutal simplicity. It is the firewall against the ego, the circuit breaker against hope, and the ultimate expression of his financial humility. The number one rule for cutting losses is this: always sell when a trade falls 10% below your purchase price. Now, before you dismiss the number itself as outdated market volatility today is different than in the 1920s. Understand the philosophy behind the percentage. The specific number is less important than the pre-commitment to a fixed, small, and non-negotiable limit. For Livermore, the 10% was his absolute maximum tolerance. It represented a loss that was small enough to be mentally dismissed and easily recouped with the next winning trade, yet large enough to tell him that his initial reading of the market was demonstrably wrong. This rule is a declaration of war on the human tendency to rationalize. The moment the stock hit that 10% threshold, the trade was over. No questions asked, no waiting for news, no checking a technical indicator, no hope. It was a mechanical, automatic execution. He treated it as a sacred law of his trading business. He understood that if he allowed himself to violate the rule just once, he would violate it again, and the entire system of his self-discipline would collapse. The genius of this rule is its predetermination. The loss is defined asterisk before asterisk the trade is placed. When you are deciding where to buy, you are in a state of cold, rational logic. Your focus is on the potential reward. Livermore forced himself to shift that focus to the potential cost, the risk. By setting the 10% rule, he calculated his maximum financial exposure for every single campaign. Before the first dollar was committed, think of it as the cost of being wrong. If you have $100,000 capital, and you put $10,000 into a position, a 10% loss is only $1,000. That $1,000 is your tuition fee. It's the price you pay to learn the market is not ready to move in your favor. You paid the fee, you got the lesson, and you still have $99,000 of capital and a clear mind, ready for the next, better opportunity. The alternative, which destroyed countless speculators, including Livermore himself multiple times, is to say, I'll wait until it drops 15% or 20%, or maybe I'll sell when I feel uncomfortable. Feeling uncomfortable is not a trading plan. It is a recipe for disaster. By the time you feel uncomfortable, the loss is often already too large to recoup without extreme effort and stress. Livermore's breakthrough was the realization that winning in the long run is simply the process of managing a series of small, inevitable losses until you catch one or two massive winners. You cannot manage losses unless they are small, and they cannot be small unless they are cut instantly and without emotion at a predefined limit. This rule is the linchpin of his entire philosophy on capital preservation. It is the anchor of longevity. But how does this seemingly ancient rule defined in the era of ticker tapes and stock pools translate into the high-speed, algorithmic trading environment of today. The principle is timeless, but its application requires a modern interpretation. The market has evolved from ticker tapes to algorithms, but the human fear that destroys accounts remains unchanged. Livermore's rule is your algorithmic defense against your own emotion. The modern trader operates in a world Jesse Livermore could only have dreamed of: instant executions, zero commissions, and leverage that can amplify gains or losses in seconds. Given this speed is a rule from a century ago, tied to an arbitrary 10% figure, still relevant. Absolutely. The principle is not about the number. It's about the pre-commitment to a maximum financial limit. For the modern speculator, Livermore's number one rule is simply the mandate for a hard stop loss. In his time, Livermore had to manually enter the sell order, battling his own nerves in the process. Today, you have the mechanical advantage of placing a stop-loss order the very second your entry order is filled. This removes the entire psychological battle. You are leveraging technology to enforce the discipline that Livermore had to enforce through sheer, painful willpower. Here is how the modern interpretation works. 1. Define your risk tolerance R. Instead of a fixed 10% on the price, the modern trader applies Livermore's philosophy to their capital. The rule becomes: never risk more than 1% to 2% of your total account equity on a single trade. This is the position sizing rule that flows directly from Livermore's loss-cutting mentality. If you have $50,000, your maximum loss on any single trade is $500 to $1,000. 2. Calculate your stop distance based on your technical analysis. For example, support resistance, average true range. You determine the ideal stop-loss price where your original thesis is clearly invalidated. 3. Adjust position size. Now, you calculate how many shares or contracts you can buy so that if the price hits your technical stop-loss point, your total loss does not exceed your 1% or 2% risk tolerance R. This approach is the modern evolution of Livermore's principle. He was saying, I will only allow the stock to drop this much. We are saying, I will only allow my capital to drop this much. The difference is crucial. By focusing on a percentage of your total account, you make the decision scalable and independent of the specific stock's price or volatility. The emotional benefit remains the same. When you know, before the trade starts, that the worst-case scenario is a minor pre-budgeted loss of 1%, the pressure is entirely removed. You trade with clarity and confidence. You are not emotionally anchored to the outcome, because the outcome, in terms of damage, is already capped. If the trade hits your stop, the computer executes the order, and you simply move on to the next opportunity, with your capital virtually intact. Livermore's longevity stemmed from his understanding that the market's randomness is a constant. By using a hard rule and emotional barrier, he immunized himself against the one thing he could control: his reaction to being wrong. For the modern trader, your brokerage platform and your risk management plan are the tools to achieve that same unyielding discipline. Never let your ego override the system you set up in a moment of cold, hard logic. Knowing the principle and its modern application is one thing. Making it a habit is another. Let's move from philosophy to practical implementation and outline the step-by-step process of integrating Livermore's ultimate survival rule into your daily trading routine. Discipline isn't a feeling, it's a procedure. We must engineer our trading environment so that the system makes the decision, not the emotional human. We have analyzed the psychology of loss and defined the principle of quick, non-negotiable exit. Now, let's build the mechanical defense system that Jesse Livermore utilized. Translated for the modern trading desk, this is the step-by-step procedure that ensures you never violate his number one rule. Step 1. Determine your maximum risk per trade, the R factor. Before you even look for a stock to trade, you must set your Livermore limit on your overall capital. This is your R factor. Based on sound risk management, you must commit to risking no more than 1% to 2% of your total account equity on any single trade. If you have a $100,000 account, your maximum acceptable loss is $1,000 to $1,000. This R value is sacred. It is the absolute financial boundary that you cannot, under any circumstances, cross. This is the modern, intelligent application of Livermore's 10% Tolerance it's applied to your total account, not just the stock price. Step 2. Identify the technical invalidity point, the stop price. Now you look at the chart. Where is the price level that, if broken, proves your initial trade idea is unequivocally wrong? This is your technical stop price. It might be below a key support level, a major moving average, or a pivotal point, as Livermore called them. This is a logical price level, not an emotional one. Crucially, you must find this price asterisk before asterisk you enter the trade. If you cannot find a clear technical stop that keeps the loss within your R factor, the next step is simple: do not take the trade. Step 3. Calculate your position size, the leverage check. This is where most traders fail. Once you have your R factor max dollar loss and your stop price max price drop, you must solve for position size. The formula is position size equals maximum dollar risk R factor. Entry price, stop price. If your entry is $100 and your stop is $98 at $2 risk per share, and your maximum dollar risk is $1,000, you can buy $1,000, $2 equals 500 shares. By calculating this, you guarantee that if the trade moves against you and hits your predetermined stop price, you lose exactly your budgeted R factor, and not a penny more. You have successfully stripped the emotion and guesswork out of the risk equation. Step 4. Place the hard stop order, the final mechanical lock. The moment your buy order is filled, you must immediately place a hard, working stop loss order with your broker at the calculated stop price. Do not rely on mental stops. Do not rely on watching the screen. Place the order. This is the mechanical enforcement of Livermore's discipline. It takes the decision completely out of your hands when the price moves against you. If the price hits the stop, your computer system executes the order, overriding your ego, your hope, and your shame. This 4-step implementation plan is the modern manifestation of Livermore's #1 rule. It transforms the chaotic, emotional act of cutting a loss into a cold, rational, predetermined business process. You are trading like a CEO, not a gambler. By making the loss-cutting mechanical, you preserve your capital and, more importantly, you preserve your mental capital for the great winning trades that inevitably follow. We have reached the end of our journey. How do we take these mechanical steps and integrate them into a philosophy that ensures not just survival, but ultimate success? Let's close with the cinematic sign-off. Tying emotion, discipline, and longevity together, the market is a battlefield that sees many brilliant minds fall. The difference between the warrior and the ghost is the willingness to accept the small defeat to ensure the ultimate victory. We started this journey by acknowledging the brutal truth. Survival is the only true measure of a trader. We've dissected the inner conflict, exposed the psychological trap of the ego, and armed ourselves with Jesse Livermore's #1 rule, the pre-commitment to a small mechanical loss. We've given this principle a modern, step-by-step implementation system. Now, I want you to look at your trading screen, not just as a display of prices, but as a reflection of your character. The decision to cut a loss is not a financial one. It is a moral choice you make about your discipline. When you violate that hard stop, you are not disrespecting the market. You are disrespecting yourself, the rules you set in a moment of clarity, and the future opportunities your capital represents. Livermore's entire career, his rises and falls, teaches us one singular, undeniable lesson. Never let a mistake turn into a disaster. The market will always be there. The opportunities will always be there. But if you allow a loss to run, if you allow hope and ego to tie up your capital in a dead trade, you are deliberately making yourself unavailable for the next life-changing move. You are sacrificing your longevity for the fleeting satisfaction of avoiding the admission of a small error. The secret to longevity is not complex analysis or predicting the next economic shock. It is the simple, repeated, mechanical act of taking care of the downside. Imagine your trading capital as a well-trained army. Would a great general risk his entire force on a failed skirmish? Or would he order a swift, strategic retreat, preserving his troops for the decisive battle? Livermore was that general. His #1 rule was the order for that immediate, strategic retreat. When you place a trade now, you are not just hoping for a profit. You are entering a commitment to discipline. You are telling the market, I am a speculator, not a gambler. I have my limits, and I will honor them. This is the foundation of confidence. True confidence in trading doesn't come from winning. It comes from knowing that even when you lose, you are in full control of the damage. The greatest traders are those who treat every trade not as an attempt to get rich, but as a risk-managed experiment. And if the experiment fails, you note the failure. You pay the small fee, and you move on, wiser and ready to redeploy your intact capital. This is the ultimate, humbling lesson passed down from the master speculator. What is the biggest losing trade you held onto because you violated a hard stop? Share your story in the comments below, and let's learn from the discipline this community needs. Go forth, armed with this knowledge. Trade with discipline, trade with humility, and always remember that your first job is to protect your capital. Because as long as you have your capital, your opportunity ticket is still valid. May your analysis be sharp, and your losses be small. Thank you for listening. Now, go enforce your rules.